Hello, my name's David Linton, and today I want to talk to you about price targets on Bloomberg. We've recently launched them on the Bloomberg, and this presentation is designed to help you understand how to get the most from them. They build on an old point and figure technique of how we now put these price targets on time-based charts. So it's a groundbreaking new way of predicting price targets. And if you've got them on your Bloomberg already, hopefully this will help you get the most from them. So where these price targets come from is where I'm going to spend a bit of time to begin with. Then we're going to talk about understanding time horizon, using key price levels to understand the importance of these levels, price levels, and then averages for trend definition to interpret the targets, and mostly we're going to spend most of the time talking about how to interpret the targets. And this presentation will be available at this address, and the PDF is available on your Bloomberg. So basically, a little bit about me. I started out trading in London traded options market in the 1980s. Used technical analysis back then. I founded Updata, a technical analysis software company in the UK. I'm qualified. I've got a CFT, MSTA in the UK. I teach on the diploma course for the Society of Technical Analysts, and I've got a master's in financial technical analysis awarded by the International Federation of Technical Analysts. I do a lot of training, and of course, I'm a regular commentator on markets. We announced these price targets at the IFTA conference in 2023, so they're just over a year old now. They've been well taken up by a lot of users in my own software company, but now they're on Bloomberg. We're pushing these further. And I joined Trevor Neal, who was head of technical analysis at Bloomberg some 20 years ago. And I joined Trevor as a trainer now in Beta Group. And now the latest thing is we launch these price targets on the Bloomberg. And I'm a member of the Chartered Market Technicians Association in the US, the American Association of Professional Technical Analysts, and various other bodies. And I've got 33 followers on LinkedIn. So if you're not already following me there, I'll be doing quite a lot of updates about using these targets on Bloomberg on there. They've recently been peer reviewed in the International Federation of Technical Analysts journal, and this link in the presentation, you can download the journal there and read about them in there as well. So where do the targets come from? Well, as I said, it's an old technique reimagined. Apps Lin Go on your Bloomberg will take you to this function on Bloomberg, but basically these are fully automated targets. You hit that key and then you put them on. So where they come from? Well, point and figure targets were invented over 100 years ago, and we'll look at a little bit of the development of that. But really, the groundbreaking book was this book by Abe Cohen in 1947, and this was the Chartcraft method, the 3-box point and figure chart. This is where really this comes from. So Abe Cohen's book in 1947, very hard to get now, but that is where these targets come from. And so that is really the basis of this technique. And point and figure was basically developed, as I said, over 100 years ago, where price information was coming out of the ticker tape, and point and figure charts. Anyone who's been doing technical analysis pre-computers will know all about point and figure charts, and this was a way of recording the price action without having to record every single tick. And back in those early days, we were exploring ideas of price congestion and thrust. In the 1920s and 1930s, this whole basis for these targets was developed that long ago. But as I say, it was a necessary shorthand. The ticker tape prices were coming out. That was the noise of the market. And what people did was they just recorded the key numbers as they came out, so key round numbers. And then this was the figure chart, and then they realized they could actually just record points on a grid, and this is really where point and figure charts were born. So Cohen was the first to identify this idea of double top buy and double top sell signals. These were unambiguous signals, not to be confused with double tops and double bottoms that we normally talk about in technical analysis. The way you differentiate is by saying a double top buy or a double top sell. These were patterns and signals that were part of this grid. And what Cohen came up with was this concept that that first initial thrust off a low, that buying thrust off a low, would then give a resultant move target. And this was the method for deriving point and figure targets. And it's well written about in his book. Very simple concept, and that was really very well used before the age of computers. But when this is a modern point and figure chart, an update, so when point and figure charts came along, basically they were much harder to computerize and construct properly, and so really they've sort of fallen out of favor because a lot of people struggle with, one, getting the right chart, and two, being able to draw them and interpret them and understand them. But these are the targets, and that's where they come from. And then, of course, the internet changed everything. Every price and every trade could be recorded. There was no real need for this point and figure shorthand anymore. So that was a really key aspect to it. So the problem with point and figure charts is the proper charts are not easy to get now. The charts are not easy for the newcomer to learn. They're considered old-fashioned. The shorthand is no longer needed. There's no time in a point and figure chart. The x-axis is actually reversals, where you reverse into a new column when you do that reversal. So there's no time in a point and figure chart, which then means that there is no time frame on when the target might be met, and that's what these price targets on the Bloomberg are really designed to help you address. And one of the things that's really come out of this is it's hard to know when a target is failing with time, and that's something that we can now see with these new targets on time-based charts. So there's nothing wrong with the method, it's just deemed to have been largely superseded. So if you imagine this chart on the left here, this is a chart of gold. These are the point and figure targets on the gold chart, and these targets now being transferred, the same targets transferred onto a time-based chart. Very simple. Which chart is easier to understand? Well, our research has shown that many more people will want to look at targets this way than on a point and figure chart, which they may not be easily able to get in the first place. So one of the key things is understanding time horizon. We'll come back to this, but I'm going to talk mostly about daily charts. And we're looking at a daily chart, we're thinking weeks ahead. I wrote a book, Cloud Charts. I wrote a book on clouds, Ichimoku clouds, and this table was in that book in 2010. And basically the idea is that the daily chart means weeks, a weekly chart means months, and an hourly chart we're thinking days. And so time frame is a really important thing, especially when we're thinking about when the time a target might be met. So we'll come back to this concept, but it's very important to understand that your chart interval controls your time horizon. One of the beauties of technical analysis is that you can literally control your time frame by just changing the frame of the chart. So the other thing is identifying key levels, because what we really want to do is make sure that targets are lining up with levels of resistance and support. And what we do here, we've got on the Bloomberg this function, the Linton levels, where you can actually basically set this. My default is 3 bars before and after. So if I've got a point where it's the highest point 3 bars before and 3 bars after, then it draws a level on the chart, and those become levels of resistance and support. And so these bars before and bars after are really quite key. Watch for these levels lining up with targets. This is the main reason for showing this. As you can see here, we've got a price target. There's a previous level coming off a previous high point, and it's lining up with the target. When you see the targets lining up with resistance, that's really important. The settings for this are very straightforward in the Bloomberg. You just tick the tick here, Linton levels, you tick the tick here, and these are the defaults. You can change it to 4 periods, you'll get fewer levels, or 2, you'll get more levels. So totally up to you, and you can configure the colors and everything, of course, as well. 2 levels either way is when you here, 2 levels either way just show that you want to extend those 2 levels either way, and these other ones will not extend. But if you wanted to see more levels, you can just extend that. But I like to just see the next 2 levels of resistance and the next 2 levels of support, and how they're lining up with the targets. That's really important. So trend definition is also another very important factor. And we're using a simple trend filter here. This is a midpoint average. These are the inspiration for Ichimoku charts or Donchian channels if you've used those before. I feel this is much better than a standard moving average. And we see that this is the midpoint of the trading range, and we see that price interacts with this midpoint average, and so that is also included in the targets functionality. So you can actually see that you wouldn't want to take upside targets when you're on an uptrend and downside targets when you're on a downtrend. So plotting this midpoint, I use the 21 days as my default, roughly a month, and that just gives me a good idea of whether we're in an uptrend or a downtrend, and then how I should read the targets accordingly. The settings for these are very, very straightforward. It's just the period and what color you want the line. So again, that's another function that just helps you interpret the targets. Now, interpreting the price targets themselves, remembering we're thinking time frame, we're thinking support and resistance, and we're thinking trend state. We want to take those things into account, which is why I talk about those first. But now we're going to focus on the targets. So they're part of the point and figure technique. Abe Cohen's book is really where this comes from. If you want to get into point and figure, the definitive guide to point and figure by Jeremy Duplessis. I worked with Jeremy for 15 years. We worked together on point and figure charts. I edited this book, in fact. And this is the definitive guide to point and figure. So if you want to understand the full subject of point and figure, that's the book. But really what we've done is we've just taken the vertical targets, which were outlined in Abe Cohen's book. Jeremy covers them in detail in his book. But this is the point and figure charts. Now, if you don't want to use point and figure charts, but you want to use the targets, that's the whole point of this new way of thinking about the targets. So the definition of a point and figure breakdown, what we want to do is we want to just think about how they look on a point and figure chart and how that would translate to a price chart. So this is the double top buy. The idea is you're going to thrust off a low. You don't step back by more than 1 unit. We now talk units instead of boxes. You don't step back by more than 1 unit. You then reverse, locking that column by at least 3 units to create a new column of the reversal, and then you go again and you need to break at least 1 unit higher to activate this thrust target on this column. So that's what we know as the setup, and this is a filter, which means it becomes rules based. So that's really quite key. You can vary the reversal, but we'll talk about that later. The key thing is this number of units is the grid, if you like, that makes these targets automatic, and that's a really key thing. It's fully automated on the charts. Targets are about thrust. I've got a cricket ball here, and basically what you imagine is if you want to throw this cricket ball, if you're on say at the outfield and you want to throw this cricket ball all the way to the wicket keeper, you need to pull your arm all the way back, and the further you pull your arm back, the further that ball is going to go. Could be a baseball if you're in America. If you're a cricket fan, then you'll understand the concept that the more thrust you give it before it leaves your hand, the further it's going to go. And so that's the idea here. The bigger this initial buying move, and then a pullback, and then a move above that buying move, the greater the upside potential. That's the simplicity of the price targets. So the key ingredients we need is we need a move off a low, an uninterrupted buying thrust, a minimum pullback to a higher low, there's Dow theory there, and then a move of at least 1 unit above the buying thrust to activate that buying thrust to give us the overall potential. And so that's really the key behind this, and of course the same works in reverse for a downtrend. So the target structures are basically these rules, and if we throw a trend in, that just helps us understand that we're now in a new uptrend, that new buying wave pushing us above the trend, and then we push to a new target. This is the setup. This resultant move is from Cohen's work that if you use the 3-box reversal, this first move is a third of the overall potential. So we should move another 2 times that move. So looking at them on the Bloomberg, it's really simple. These buying thrusts here lead to these price targets. And so that target price there is given as a result of that move, the pullback in price, and then the activation of a unit above. There's another one here which has done the same thing. We pull back and the activation. The dot is the activation point, and these little lines are the activation levels. That's the unit size, and it's that simple. Those buying thrusts there lead to these targets here. That's how it works. So upside targets, here's a little bit more just in terms of the number of factors that we have, and we will look at these when we get into it. But the idea is that we can now break this structure down, and the two things that we're really thinking about is how high, what's the target price level, how far are we going to go, and how long is it going to take to get to the target. That's the really new bit, is how long will it take, and thinking about that on a chart. The same is true with the downside target. So this is a thrust off a high. That's an initial selling thrust, a reactive move. A move below that initial level, the previous thrust level, gives us a downside target and a time to target as well. So it's just the same. So how long and where and when will we go? That's the really key thing. So thinking about the price targets, we're going to talk about target status, unit size in terms of sensitivity and time horizon, price target projection variables, in time to target methods, and the price targets increasing their accuracy, and the recommended settings. So there's the defaults to use. So this is what you see when you first draw them. And as I say, it's the function on Bloomberg apps, Lin Go. Take a 30-day trial and try them for yourself. And so it draws the targets on automatically. I've also drawn the levels and the average just because that adds extra weight to these targets. So we see here we've got downside targets are in red. This target's becoming less valid now with the passage of time. And then we've got an upside target, which you could probably say was as good as met. That's a key thing, is the targets are not precise. They'll often be just met or exceeded, and we'll talk about the meaning of that as well. And then we're in a new downtrend, got a new downside target just been given. This is the level that we're now looking to, and that's when we might expect that the target is met. So we think about target notation. These are the unit size. That's the quite key. We can put that on the chart. We'll show you that when we look at the demo in Bloomberg. An unactivated target is orange. That target will turn green if we move and activate it. It will become a bold green target. A target that's been met already goes from being bold to just a lighter target, so you can see how well it's worked. This one's been met, so again, it's not in bold. This one is bold. How do we resolve this? We've got an upside, we've got a downside. This one has actually been activated. This one's been activated. This orange one hasn't been yet. So just thinking about those, and again, all of those are configurable in the Bloomberg. So just thinking about the status of the targets. Here's an upside target. And these are point and figure terms, really, where a target is achieved, a target is activated, and a target is negated. If we move back below the level where the thrust column was given, all those bulls, all that buying movement has now been negated. They've all sold. The setup is no longer valid. So that's a target negated. But typically when a target is activated, we're thinking the target is in train. What we're looking for now with these price targets versus the point and figure ones is seeing whether a target is actually exhausting, and is a target deactivating, or is it failing? Do we move back below that low to make a new lower low that suggests the target is starting to fail? So with these being drawn on time-based charts, we have the ability to just see how these targets are actually faring as we move on. So here we see the target negated. Here we see the target failing. This is the downside version. Negated if we move to a new high. All those sellers were wrong. They've gone. Buyers have come back. The setup is changed. So the same works to the downside. So you can set the target status in Bloomberg with the colors here. So you can go solid line, and then the line thickness and the colors. They're all set for you, but if you want to change them, change the colors, you can do. Here we use this traffic light system, remembering this is the pattern. So when this activation occurs, this target will turn from orange to green. So it's not yet activated, and that's quite a key aspect. But all of this is configurable in the display settings on the Bloomberg, but again, they're all preset for you. Target negation actually happens in two ways. You can get target negation after activation, and that's a darker gray one. And so here, this target would have been activated. When it's negated, it turns from red to gray. I don't show the negated targets on my system because once they're negated, I'm really no longer interested in them. But you can do if you want. And so the targets will disappear if you're using the default settings. If they're negated, they're no longer valid. So here we see a target that was never activated. So it turned to orange when it was first drawn. It would have been orange, but it never activated, so it never turned to green, and then it was deactivated or negated. And so then once we were negated, it went from orange to grey, and those ones we give a lighter grey to, because you should wait for a target to be activated. It was never activated, so it was never really a valid target. It was valid, but it was never activated with that extra move that's required to activate the target. I don't draw the negated targets on my system. I just think it's easier just to focus on the ones that are achieved, the ones that are activated and not yet achieved, and the unactivated ones just gives you a little bit of a heads up that if we move to a new level, then they will activate. So let's talk about unit size. And you imagine here, this could be $1. So each dollar we move up, those would have been the point and figure crosses. Each dollar that we move up, and then we reverse by 3 units, and then we activate by a unit. So this 3 units is the pullback, and that's a variable. But for the moment, that's the standard that we use, and that's what the default is, and we recommend you use the default. And I'll come to reversal. So the unit size is based on price. That's where you want to start. And the rule of thumb with point and figure is that you would use a value that's roughly equivalent to 1% of the price. So here I've got a chart of sterling cable. 131 is the level. The unit size that you would want to use there is 1 cent. So 0.01, 1 cent. And that's what you would use, and that gives you a unit size that then gives you a target. So that is all of these 1 cent moves, a reversal at least 3 cents, and then a move higher, at least 1 cent higher, will give you this setup. Here we've got gold. Now, of course, gold is very different price denomination, $2,658 here. So here we'd want to use a unit of $25. And so that means now that each move of $25 would be across. We need a reversal of at least $75, and then a move above that thrust of at least another $25 to give us that setup. The key point here is that 1 cent is what you'd use on this chart, and $25 is what you use on this chart. So understanding that the unit size based on the price then is effectively a level of sensitivity. So for example, this is the $25 chart. We could go to a $5 chart. You'll see now there are more targets on this chart. There's actually a little reversal target that's not showing up on this chart because now we're using a box size or a unit size of $5. And so this is really quite key. And if you click this box here, it will show you the unit size on the chart, so you can see what unit size is being used. And that's really just a handy way of just knowing what your unit size is. So the interesting thing is this chart is less sensitive and this chart is more sensitive. So the smaller the box size, you'll get more small thrusts and reversals generating more targets. The larger the box size, you'll get fewer thrusts and fewer reversals and fewer targets. So that's the sensitivity element of what we know as the point and figure box size or the unit size for these charts. Now, you can actually use true log scale, and so and we'll come to the pros and cons of using arithmetic box size or percentage log scale, but this is a percentage scale now. So 25 was nearly 1%. The box size is uniform in that instance, but if we use 1%, this is now going to vary the unit size as we move up the chart. So we see here it's a true 1% of price, and that means these units get bigger and bigger and bigger as we go up the chart. So 1% box size or unit size will actually exaggerate the upside price targets. And again, this is the area where you would use the log calculation. So that's just the difference between arithmetic and log. Just to make life even more interesting, you can use close prices or high and low prices. And if you imagine on a high-low price, you'll just get levels that you wouldn't have seen on the closing price. Point and figure traditionally used every single tick. So high and low gets you closer to that. And so that's another technique that you can use, and you'll notice that these targets just vary slightly because we're using high-low in the calculation, and we will have had levels that have been met on the high-lows that haven't been on the close. I traditionally use close. It's somewhat academic. The main thing is you get price targets. Here you did get an extra target that you wouldn't have got with the close. So up to you which one you use. Default is close. So remember that time horizon table. Well, this is the key. We recommend, if you're using log scale, or using about 0.5% of the price or arithmetic. That's on the daily chart. If you're looking at a longer term chart, you'd use 1%. Shorter term hourly charts, you'd use 0.1%. You want to vary your unit size based on your time horizon, remembering that days means weeks, weeks means months, and hours means days. So it's going to vary where the targets project to as well. But the unit size is a key factor in the sensitivity of the chart. So here's a daily chart of gold. This is a medium-term chart. We're using 0.5% of the price. And then if we go to a 60-minute chart, you'll see now that we've got downside targets kicking in that we're not seeing on the daily chart. And here we're using 0.05% of the price. So it just shows you that concept of the difference between short term and medium term. And if we went to a weekly chart, a long term, we're now seeing targets. This is looking back some 20 years. We're now seeing targets coming on the chart here as well. So, and then we're using a unit size of 2.5% of the price. So that's really big. If you think about it, that's about $60 currently. But of course, when we were back at $1,000, that would have been about $30, probably $20. So really quite key how that unit size is changing as we go up. You would not normally use weekly for point and figure chart, but it has a value with time projections because we can put these targets on longer term charts. Drawing a daily chart over 20 years with a lot of noise, and we'll come back to talking about the weekly side of things. So now let's think about the price factor, the target price. Now in Abe Cohen's book, it was 2 times, and that was his method, and that was his method only. Log scale charts were virtually impossible to do without a computer, and so those basically that 2% log scale has really become possible with computers. But we could look at using other factors like 1 for pattern, 1.618 for Fibonacci, or any factor we like. And then, of course, we just need to also think about the pullback factor, which I'll talk about. So the target factor is 1 times in this instance, and that's what we know as pattern. So you can set these targets up to just find consolidation patterns. Forgetting all about point and figure, really, it's just a thrust, a move, and then another thrust. And that's the rule of thumb with price patterns. The move into the pattern and the move out are roughly equivalent out of a consolidation phase. So the move out is roughly equivalent to the move in. If you break higher, that's what you would at least expect, 1% of the move. So that's 1 times the move. So that's an interesting aspect for the target. And you can see here we actually went further than 1. So that's just using 1 as your rule of thumb for pattern. 0.618, this is effectively like a Fibonacci extension, and this is a way of automating it. It's rules-based. It doesn't require you to draw the Fibonacci levels on the chart. It just puts them on the chart automatically. So again, you could use 1.618 as a target factor. If you feel 2 is just exaggerating those targets too much, you set the target factor here in the settings, and that governs how far the target will project. Target values, if we use 2, this is the classic point and figure method, Cohen's method. If we use 2, the classic point and figure method, the chart graph method, you'll find you get a target that is one move, and that target is 2 times in price that thrust. That's where they come from. And that means here that this will be, the target value will be multiple of the unit size. So you can divide this by $25. And we see here that that move there is 2 times that move, and this is the activation level. That was the end of the thrust, and this is the start of the move. That target's given here. You know at this point that this is the projected likely move, and so this is the original 3-box method. Target factor 2 times log scale will now exaggerate this target further, remembering that these units are increasing as we go higher and higher up the price. So if you're using log scale, your targets will be bigger, and so that's quite key. The target values will not be round numbers now because they are log scale. Very rare that would be a round number, it's just a decimal. But this is because that's one move, and now the unit size is varying as we go up the chart. That exaggerates the target further. So that's a 1% unit size. The log scale must be used, upside targets are over exaggerated, and the downside targets, if you think about it the other way, the downside targets will be under exaggerated because the unit size is getting smaller and smaller. So in uptrends, your upside targets will be exaggerated. The counter trend targets will be under exaggerated, so that can be quite interesting. Adjusting the pullback. So in Cohen's book, he talks predominantly about 3 unit pullback, but you could effectively use a 2 units pullback or a 5 units pullback. You could go or anything in between. But 3 units came from the 3-box method. The bigger the reversal, the bigger the target. So smaller reversals means more targets, bigger means fewer. And the pullback is like an elastic. If you pull back, the further you pull back, the more it's going to exaggerate that target. The less you pull back, the less it's going to exaggerate that target. So definitely just one to think about there in terms of adjusting the pullback. And so here we see a 3-unit reversal, which is the standard, a 2-unit reversal, and a 5-unit reversal. Now, we do recommend that you stick with 3. 3 is probably the sweet spot. 2 produces more targets. So you see here you would normally get more targets on a 2 reversal, and 5 produces too few targets and often too exaggerated, because now it's going, if you think about it, in this instance, this is a third of the move, the 3 unit. This is a half the move, so we're only going one more time. And this now is a fifth of the move, so there's another 4/5 of the overall structure. So just varying the reversal, unless you know what you're really doing with these, I really recommend you stick with a 3-unit reversal. So should you use arithmetic or log scale price units for the targets? And this is an interesting debate. And basically, arithmetic, you can see here, it's equal moves all the way up the chart. Log scale, these box sizes get bigger and bigger and bigger. Which should you use? So if you're trading one instrument, or you're very focused on one market, let's say you're an oil trader, crude oil, then these round levels become really important in terms of price. So this is crude when it's at $78, and here I've marked on the key levels that the unit size is going to use. So every 10 cents between these levels is going to be really, really key. So here, this is every dollar is going to really count, and so you want to think about every 10 cents in the move is going to take you through those round levels, and that means your targets will also project to very round levels based on those moves. So where there's psychologically important round levels, like a dollar, levels are important to traders, then the arithmetic chart is probably the better one to use. Here we see crude oil on the 60-minute chart, and now we're thinking 5 cents. So every 5 cents becomes really, really quite key, and that's going to give us downside projections to round levels. So here are the targets that have been met, and these are the upside targets that have been met, and we've got a new downside target, move, reactive move, and then we activate that target. So that's based on these round levels. So you can go right down to 1 cent for very short trading. And if you're day trading these products, then you'll want to do that. If you're looking at lots of charts, so if you're a stock analyst, for example, and you're looking at lots of different charts, this is where log scalping can be really valuable, because you're then taking away the different unit sizes. Traditionally, people used to use $1 on US stocks, and $100 was kind of the sweet spot where people wanted their stock price to be. If stocks moved many times above $100, then they would have a stock split back to near $100. That was a psychologically important level. But what we're seeing is that prices really do vary, and this is where a log scale is really good. And you just choose that as your log scale. This is a 0.5%. This is Apple, Amazon, Google, Microsoft Meta, and Nvidia, and all the different targets on the same percentage size. So if you're looking at lots of different stocks or lots of different charts, then that's good. I personally use a 0.5% log scale on all my charts because I'm looking at lots of different charts, and the targets for me, as I said, are approximate. I'm not relying on that key absolute level break. I just want to see where the targets are. If in doubt, use log scale, because it just means that you're using that universally across every chart you're looking at. So key points about the targets: they are approximate. Not all targets are achieved. Targets pointing to key price levels increases the likelihood this resistance and support. Multiple targets pointing to the same price area, that's what we call clustering. Nearest targets must be met first, and beware improbable ones. Targets not reached or exceeded indicate bullish and bearishness. So if a target is not reached, that's an indication that we're slightly bearish. On an upside target, if it's exceeded, then that's more bullish. And on downside targets, if it's not reached, that's indicating some bullishness. And on a downside target exceeded, that's indicating more bearishness. You can have opposing targets, and we'll talk a little bit about that, but you favor with the trend. And just understand this concept of negation and activation, which we just talked about earlier. So the time to target. How long is it going to take? Now, this is the really groundbreaking area of these targets, because traditionally they were drawn on a point and figure chart. You had no idea as to when a target might be met, and this is what this attempts to address. Remembering that the bigger the move off the low, the pullback, the bigger that resultant. That also implies probably the longer it will take. If the target's bigger, it's probably going to take longer. So target price is about a factor. Time to target really is about method. And in point and figure charts, the first rule is targets have no time scale. So we're now trying to attempt to give the target some time scale, bearing in mind that caveat that you cannot be certain when a target is going to be reached. So there are 5 different methods that we've come up with. Price time ratio is the simplest and the preferred. That's the one I use, but I will take you through now the 5 methods. These are all configurable in your Bloomberg, but this initial thrust, how far is the resultant move, and then this how long is it going to take is really the key. So, and there could be more methods, but these are the 5 that we've come up with. Time to target is in your top of your settings for this first method. So here we see this time price ratio. This is copper, HG. Here are the targets. And what we see on this chart straight away is that this target was actually met earlier. This target here was actually met earlier as well. This one was also met earlier. So these targets were met earlier. This one was also met earlier. So this was set to 2. That's the factor we recommend. That's 1%. Remembering this is a 0.5% chart. So 2 means 0.5% for every unit every 2 days. That means 1% every 4 days. And has this been right? Well, we can see these targets were met sooner. This is the time up, time down percentage, the method, time price. So what we can do now is if we look now to change it to 1. So now we're saying instead of it being a unit every 2 days, we're now going to say it's a unit every day. now is saying that the price actually was met a bit later. Here it was met again a bit later, and here it was again met a bit earlier, and this one here was met a bit earlier, but it's closer at 1. Is it better? Who knows? The argument is, should I use 2 or should I use 1? If you're trading something intimately, you might want to play with these targets and you'll start to see the characteristic of an instrument. But if you're not, then I recommend 2 to 1. It doesn't really matter too much. But the key thing is it just does give us an idea of when a target might be met. So this is the time price ratio. The second method is thrust angle. So this method assumes that the steeper this initial move, the steeper the thrust of that initial move, the steeper the thrust of the target. Now, and it makes an assumption. So in this instance, we're saying, and you can curve fit, so you can adjust these levels, but we're saying here that the idea is that that thrust is now steeper because this thrust is steeper. And so these targets will now not be parallel. They'll all point in different ways because of the thrusts being different. So it takes no account of how long it takes to activate. The targets are not parallel, but it's another methodology, and you can vary the factor for up and down targets because down targets are often met faster than upside targets. Time to activation, this is another methodology. This just assumes the longer it takes for a target to be activated, the further the target will take to activate. Just means that there wasn't very early strength in that activation. The thrust was there. It took a while to activate. The longer it takes to activate, the longer the target. So it takes no account of the speed of the thrust. The function is the time it takes to activate. And you'll see here it's time to activation in your system. The longer a target takes to activate, the longer it'll take to be met, is the assumption. And again, these targets are not parallel because of the different times taken to activate. And here we're using 4 times. This one is follow the price. So this one is quite interesting. This one basically assumes that you don't know really when it's going to happen, and all we're going to do is we're going to just track the price, and that is basically giving us our target trajectory. And if we ignore the last n bars, that means we can see any move away from the target trajectory. So by ignoring the last n bars, your target is drawn, and you can start to see any wandering or move away from that. So that's quite important. So this one is just simply, I don't know when the target is going to be met. I'm going to track prices and how they're moving, and that's going to keep moving my target based on how we're tracking. So that's another key factor. The last one is historical average, and this basically measures the number of targets that you have configured. So you can configure the number of targets. I normally use 5. But you could click here, show all targets, and it will show all of the historical targets on a chart, even if there's 100 of them. And this will now then give you an historic average. So on copper, in terms of moves to target, 1.4 times is the up and 1.6 times is the down. And that's just based on the historical average of when the targets were met. So that's also quite key. I personally, this is quite an interesting one where it just says, well, I'm going to look at how well they worked historically, and I'm just going to go with what's worked best historically on average. So there's 5 methods, but as I mentioned, my preferred method is time to target. This is this time to target average. So looking back here several years, you can see all these targets have been drawn to where they've been met. And those targets there are projected on the basis of the average of when those targets were all met. So how long did it take? That's the slope. That's using that last method. And this one used 50 targets. Gold, average of the last 50 targets. That's just showing you here 2.2 times up and 6.6 times down. This is a daily chart. So, and this was a 0.5% unit. So if you like, 0.5% of the price takes 2.2 days on the upside and 6.8 days on the downside. So it takes longer in this instance for the downside targets to happen. So the way to think about that is 2.2 units a day. So that's 1.1% a day, if you like. And then downside targets is, so I've just multiplied the unit by 2, and downside targets, you just halve that because of 0.5, 3.5% downside in a day is the average. The average en route to the targets, not average price movement, the average when you have a target in train, which will be very different from the overall price movement. How many targets do you show? Well, I use 5. So 1, 2, 3, 4. You can just see here the targets, and there'll be many more. If you zoom back on the chart, you can look at more, but I use 5. You can enable it to do all the targets, but given that you're calculating all of that data on chart that you're never looking at, so it slightly depends on the chart zoom to see how well they've worked. So time up, time down here is 1, but that's how many should you show? The default is 5. So let's think about increasing the accuracy of these targets by thinking about time frame, support, and resistance. So here's a great example. This is Amex, and we're seeing here we've got multiple thrusts giving us multiple upside targets to an area. This is what we call clustering. And clusters in point and figure terms was always at a price level, but now we can cluster to price and time. So we can look at this chart and we can say, well, we've got targets of 312, 314, 335, somewhere between mid-November and mid-December. Hanging your hat on a specific date is a bit of a mug's game, but here we can see that we've got multiple upside targets. This increases the likelihood of these targets being met because we've got multiple buying thrusts all the way up here, so pointing higher, and they're pointing to the same price area at similar times. So that's a cluster. The multiple targets are stronger here with coffee. So we've got a good example here. We've got a downside target and an upside target. Which one would you go for? Well, the upside targets, you follow these train tracks. The upside targets are going to be the ones that you would put more emphasis on. But you have got a downside target. Just suggests that you've just got a degree of caution. If we move above this level, then that target is negated, and then we get renewed confidence in these upside targets. If we start to see these targets coming off the chart with negation levels, so we break below these levels, then we start to see the downside. But for the moment, that's what we look at. Also, by putting the average on the chart, you can see here now, the trend is your friend. We have just crossed below the 21-day average. So we may well fall before we rise. That's just understanding that. And that's how you interpret these. Also, always note the key price levels. So by putting the levels on the Linton price levels on the chart, you see here we've got levels that are then marked. And if we break below these key levels, that increases the likelihood of this chart. We break above this level, that level goes, and then interestingly, we've got no resistance levels, recent levels, but it will draw on the next 2 levels going back further once these levels are broken, because you're always drawing 2 levels. So that's quite key as well. Here we see the NASDAQ, 2 targets lining up, even though this one is historic and it never was met in that time frame. We do have another target pointing to the same thing, different thrusts at different times, pointing to the same level. We break to new highs, that target will be negated. So at the moment, that's a little bit of a mixed picture. We'd probably favor the upside. And if we put the average on, we see we're above the average. We've got the key levels, certainly breaking that resistance level. Really, then you'd look to those targets. So the trend and breaking of levels changes everything. When a target is no longer valid, so this is quite an interesting one. This is corn, got downside targets. We've got our trend. We're in a new uptrend here. We've got a new upside target. A lot of time has passed. Probably we would wait for new thrust targets to the downside rather than looking back to those old targets. 350 was the target level. We nearly got there. you could probably say that target was as good as met. We now look to this new upside target, noting that we do have resistance, strong resistance, just below where that target is at 448. If we go here to Coca-Cola, pull the side panel out so we can just see where you put those there. This is a really interesting one. We're above the trend. Target was given back in beginning of June. That was the thrust. That was the target. Price is moving all the way up to the target. Didn't quite get there. And then you'll notice here we had a key level. We fell through our average first, and then we broke our key level. We can now look at that target and say it's done. It was not quite met. It was bearish confirmation. We had a trend change and a level break, so not worth hanging on for that anymore. It was from there to there, didn't quite get there, and this is when we know the target's done. Or just wandering sideways away from the target. It was quite interesting there. That was the price time of 2. That's why we think it seems to work quite well. Looking at US 10-year yield chart. So this is a weekly chart. Beware of improbable targets. Because it's a weekly and we've got a big box size, and this is historic, and remembering this is a log scale, so 2.5% back then is projecting to 10. We've got another unactivated target to 10. If we make new highs in the US bond yield, you might start to think about those long-term targets, but we've got a downside target as well. So it's likely that either the box size or the time frame is exaggerating the targets. Look to the daily and see where the intermediate targets are. Careful with long-term charts. So here's a monthly chart of gold, and now that's giving a target to 13,500 on a 5% log scale going back 20 years. So that move over the first 5 years is projecting another upside target. We're nowhere near that yet. Now, there are upside targets. We're looking at those gold charts, but really just be careful of making very big calls. The near side targets will always be met first. So log scale can dramatically outchop them. And beware charts with big moves. So here we see Bitcoin. Again, this is a weekly chart. We've had very big moves on log scale from near zero to 50,000. That's projecting to 500,000 in 2035. But really, 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 you have to be very cautious and beware of these big box sizes, 5%, giving long-term charts on the log scale. So you can use them with other with other techniques, other time-based techniques. If you want to use all of the moving averages or indicators like RSI. Here I've got Bollinger Bands on the chart, and John Bollinger, I know John, he saw me present these in Jakarta, and very much this, John says, new ways of using technical analysis in the modern age without abandoning the value created in the past 100 years. This is really the ethos of these targets. So you can use these time-based targets, unlike point and figure, with other things like Bollinger Bands. So the settings on Bloomberg are all explained in this slide. If you download this presentation, you can go through these. And if you imagine what this setup, in terms of the setup, this is what each of these things relates to in terms of the target. You'll get to a point where you'll want to just really just use the target. So if I go to Bloomberg, and let's have a look. So one of the key things straight away, if we look, this is the NASDAQ. One of the things you'll notice is a lot of the time when you just draw the chart, the targets go off the chart. So what you have to do is just do a little bit of manipulation on your Bloomberg, and this is where you can just adjust the axes. You can actually see into the future where the targets are. If you want to zoom out, you've got to be before the current price, but you can then zoom out and you can just see the targets. So this is the NASDAQ one, those ones lining up. We talked about it. There's the downside. We're above the moving average. We break to a new high on the NASDAQ, that is going to be really looking to those targets much more. So that's an example of them on the NASDAQ. And of course, you can just go back. I've got it configured to 5 targets, so it's not showing many more. But if you wanted to see how well these targets worked in the past, you can easily just go and grab your chart. And in fact, what I'll do here is I'll do it on the Linton price targets. Go here. And what I want to do is say, what did I say? So show all targets. So if I show all the targets, update, it's now going to draw all the targets on. And you can see there were lots and lots of upside targets. So you can zoom in to those if you want. You can see all the targets there historically on your Bloomberg. Let's have a look at some other charts. This is gold. And again, I quite often like to do things like putting the Bollinger Bands on. So now to put the Bollinger Bands on, I could take off my levels if I really want to, because it's mostly an uptrend and not range trading. And I could keep my average on, or I can take it off. If I want to take that midpoint average off, I've now just got the targets with the Bollinger Bands. And again, I can then go and take that away. So here we can zoom, and those are the targets for gold. And you can see that target was given back here at this level, 2463, given to 2835, and we're now at 2756. So not quite met when it said it would be, but it's just a guide. You'd be happy to have had that information back then. Taking a look at crude oil, just another one. Zooming your charts. There's targets for crude. Targets in either direction. Right now, you would probably favor that downside target because you're below the trend. If we break these key levels, notice that level is at the support levels, so that's really important. And again, you could go to the 60-minute chart. If we go and do that, we can go to a 60-minute chart on crude. We are now going to get shorter term levels. It will adjust the box size accordingly. And so you could get a shorter term picture of crude. And here are the targets now. And again, those key levels with the downside targets. And I may want to adjust those target levels now. So that's quite key. Looking at gas, this is US nat gas. Again, I can resolve these targets. You can see actually though this target was probably nearly met there, so I probably want to change my level. And now I've got a downside target. I'm below this trend, but if we break those levels, that's quite key. And that downside target is pointing not a long way from their support level. The thruster's telling me potentially we're going back to that support level. If we look at gas, I look at a lot of energy markets. So here we see there's a target that was given on gas. It was met sooner. So I might want to change that level. So I could go and change the target. If I go to the Linton price target, and I might say, what happens if I change that to 1? And now it's going to adjust the levels. They're on my Bloomberg. And now it's going to draw those to 1. And you can see that 1, so if you're trading US nat gas, 1 might be a better level to use. And that target was given at 36. Oh, sorry, this is European gas. That target was given at 36, and it was given to just 42.6, and it was met 2 weeks later. So, this is just showing you how you do it. So carbon emissions, another good example. You do this on any chart, of course, any stock, anything you like. So carbon's been really interesting lately. Again, you want to just vary your chart a little bit. So we've got a downside target and an upside target. We're in a new uptrend, so starting to favor that. We've got resistance at that level. You need to remember these resistance levels. And 77, 78 could be a level. Back to resistance levels. So that's how you use them in your Bloomberg. Use the default settings to start with. The question I'm often asked is, have you back tested them? We've done lots of back testing, testing both negated and activated. And what we found is the results improve much better with good money management. So if you want to talk to us about backtesting, I'm happy to spend time on that. But have a play on your Bloomberg. Take a trial. It's apps Lin Go. You can follow me on LinkedIn. I've got 33,000 followers there. That's my LinkedIn address. And you can download this presentation on Bloomberg, and you can watch me there. You can email me at david@updater.co.uk. I'm happy to have a discussion with anyone who's using the targets. They really are truly groundbreaking. So have a go yourself on your Bloomberg, appslin.go. It's a 30-day trial. See if they work for you. We've had a lot of great feedback already, and I hope you enjoy them. Until next time, May the trend be with you. Happy charting. Bye for now.